Awesome. Yes, I'm happy to be here. Super excited. I think we have a lot to share. And just wanted to let you guys know beyond the housekeeping that this may go over a little bit over an hour. Be sure to stay till the very end. You are not going to want to miss a minute of this. So that's all I have to say.
I love it. Okay, Tanisha, thank you so much. I think that's my cue. Is that right?
That's right.
All right, perfect. So my name's Jonah, and I am here on this call from the Money Multiplier. And really, I've got some really exciting things to share with you today. I promise you, you're going to want to pay attention. Put on your seatbelt, go get your coffee, whatever you got to do in order to make sure that you're present. It's going to be a lot of fun. So I want to say a few things. I agree with Lindsay. Let's put our questions in the Q&A, but I do have a fun thing to do right at the kind of beginning of our presentation that we'll absolutely use the chat for. So I'm going to go ahead and share my screen, and then we are going to jump right in, and I'll start here. First and foremost, can everyone see the screen now? I want to make sure that that is a thing. Can you give me a? Oh, okay. Marie was quick in the chat. I totally see you there. Thank you so much. So the company that I represent is called the Money Multiplier, and exactly the name of the company is what I want to talk to you guys here about this afternoon. It is all about how we can multiply your money, right? Income is such a big thing for us. We need more of it year after year. If we have not made as much as we made last year, it's a problem, right? We need to use it for investment. We have to do so many things with money and income, and that's the most important thing. So today, we're actually going to talk about 4 I's, okay? And I've given you a secret. I've given you the hint for the very first I that we've got, and the very first I is income. So let's talk about it. In fact, in order to have a little fun with the income, because again, we all know about money. We all know we need it. I thought that it would be fun to do like a little pop quiz. Okay, so this is what we need the chat for. And I see Larry in the chat says, "What's up? What's up, Larry?" Thank you, Lance and Cynthia, for giving me the answers, Luis. Okay, so here's my question for everybody in the chat. On the screen now, you can see common versus uncommon income levels. And my question is on the bottom line there, to be in the top 50% of US household income, does anyone know how much money you have to make? How much money does your family have to be in the top 50% of US income? Okay, Derek says 70,000, Antonio says 120. I see 250, I see a 20, I see a 60. We got a bunch of answers coming in the chat. Keep putting them in there, and I'll reveal this very first one here. Top 50% is $41,000. Probably not as high as we were thinking, right? Not as high. Okay, what about this? What about the next line right above it? 25%. How much money do you have to make to be in the top 25% of income levels in the US? What about that number? Okay, now we've got some more realistic or calibrated numbers coming in. I got 65,000, 15, 75. We're doing a lot better. 85, 90 from Rhonda. I see that. 83,682 is top 25% of income levels in the US. Line number three. Line number three. We're getting better, everybody. Line number three. How much money do you have to make to be 10%? 10% income earners in the US. What are we thinking? 150, 250, 110, 150, 100, 101. I like that. $145,135. Okay, these last two are the important ones, right? This is what you're actually wondering. Top 5% and top 1%. Let's start with top 5. How much income do you have to make in the US to be a top 5% income earner? Okay, I see Helen jumped us up pretty high from 145,000 at 10%. She says 1 million at 5%. 2.5 from Vanessa, 400 from Kenneth, 250 from Mark, 208, 208,053. Okay, this is the big one, right? This is the big one. Top 1%. Top one, the upper echelon, right? This is the hoity-toity, whatever you want to call them, folks. How much money do you have to make in the US to be top 1%? All right, I see a million again. I see 500 million from Vanessa. Okay, 2 million from Rhonda, 400 from Scott, 400, 1 million, 5. Okay, I love it. You guys are playing along with me. Thanks for having some fun. $515,317 to be in the top 1% of income levels in all of the US. Isn't that crazy? So here's the point of me having this little fun with you and bringing it up. I think in the United States that we actually make plenty of money. We actually have really high income levels. There could be a couple of us on this call, 10, 20, 100 of us on this call that are actually top 5%, pushing top 1%, and we didn't even realize that. It's actually, in my opinion, not about how much money you make, it's actually about how much money you keep, how much you have, right? That's what I want to talk about today. But before we do that, I got one more question for everybody. What about if you want to be top 1% worldwide? Let's have some more fun. Top 1% worldwide, not just the US, worldwide. How much money do we think it is? 515 to be top 1% in the US, but how much money is it to be top 1% worldwide? Okay, I see a million from Marie, 350 from Ryan, 90, 100,000, 1 million, 2 million, 1.5, 200. I love it. Here we go. Okay, sit down. Hope everybody's sitting down. Don't spill your coffee. $34,000. If you have or make more than $34,000, you are in the top 1% of income levels worldwide. Isn't that crazy? Again, another reason why you should consider that in the US, you should consider my thinking, right? In the US, it's not actually about how much money you make, it's about how much money you have and how much money you keep. There's a QR code on the screen if you've got your phone available or handy in order to scan if you want more information about that. And also at the very end of this presentation, there'll be a QR code for you as well. So you do want those phones handy. Okay, the first I wanted to talk about, reminder that there are four. The first I wanted to talk about is income. Hopefully this little game helped you understand that it's not actually about how much you make, it's about how much you keep. And so here's my question for you. I'll prove it to you. How much income do you think you've earned in your lifetime? All right. So if you're sitting at home, close your eyes for a second. Don't worry. I won't hit any buttons on the screen. I won't mess with it. Okay. But think back to your first Christmas. Maybe grandma sent you some money. Think back to those income tax refunds back before you realized that was just overpaying the government. Think back to the bonuses you got. Maybe you won the lottery way back when, 120 or $100 or something. How much money have you earned? How much income have you earned in your lifetime? If you would, just a few of you, put it in the chat. If you really had to think about it, how much income has come into your hands in your lifetime? Okay, I see a 2 million in the chat, a 3 million, a 1.5, couple million, 1.5. I love it. I would be in the same boat as you guys. A few $1,000,000 is how much I've made. But you ready for this? Next question. How much of that money do you still control? What does the checking account balance say right now? Right? You made it. It was your money. You had it. You earned it. But we don't have it anymore, right? Not much, says Holly. Not the same. I love it. You guys are having fun with me, right? We earned the money. We had the money, but we don't still control it. We don't still have it. We actually had to spend it. Isn't that crazy, right? We made so much, but it just goes out of the window. And so here's actually what I want to talk to you about today. It's our second I word. It's our second I word. What in the world do you buy? Do you purchase to protect? It's an I word, to protect things that are valuable to you, like income, one of your most valuable assets. What in the world do you buy, right? What's the I word? I see it popping up in the chat like crazy. That is exactly correct. It is insurance. Everything that I'm going to talk to you about today came out of this book. So just in case you have not seen this book or read this book, I highly, highly, highly suggest that you purchase this and add it to your wealth building library. Now, our company, The Money Multiplier, we've got a nice link to the book on our website, but truthfully, you can get this book right off Amazon. This book is $20. I've got a bunch of them behind me on my bookshelf. This is the book that you want to pay attention to, because in this book, he talks all about how insurance is a lot of times miscategorized, specifically whole life insurance. Let me tell you a little bit about me so you understand where I'm coming from. Okay, I know that I'm on the webinar here and I'm leading. I'm going to talk to you about making more money, multiplying your money, having more, doing more. That's what I'm going to talk to you about, but that's not how I started, okay? So believe it or not, when I grew up, we were big Dave Ramsey family. That's how we grew up. That's what my parents started listening to. We had a bunch of consumer debt. We didn't really grow up with a bunch. My mom's from Southern California. My dad's from Chicago. They got together. We moved to South Carolina. We just didn't have anything. I tell the joke sometimes that back when I was growing up and we stayed in hotels, they actually put the doors on the outside. And I didn't realize until I was grown, no, those are called motels. Hotels, the doors are on the inside. I just didn't know, right? And so we didn't have much. But about a decade ago, somebody talked to me and gave this talk just like I'm giving to you. It was exactly this. Jonah, you actually are not controlling the environment where you're having your money, where you're keeping your money. You're not keeping enough of the money that you're earning, and that's actually your issue. You've got to learn, like the name of that book, how to become the bank. And that's what I want to talk to you about. So we talked about this, our second eye, insurance. That's what you purchase in order to protect your most valuable asset. Now, I know some of you are thinking, I've never really heard of income insurance. That would be really easy, right? Income insurance. Well, that's the one that I buy to protect the income. Same as car insurance. That's the one that I buy to protect the car. Or maybe vision insurance. Well, that's the one I buy to protect my vision, my eyes, right? I've never really heard of income insurance. And I agree. I've never heard of that one either. But there is a type of insurance that does exactly what I'm describing to you today. And it's actually dividend paying whole life insurance from a mutual company. I saw someone in the chat a little earlier say dividend paying whole life insurance or whole life insurance as their option. Right? So, okay, first, during this conversation, I'm going to tell you why this is actually the ideal asset. This is the thing that you want to protect your income. And I'll also tell you all about how. Now, I know some of you are a little confused right now, though, because you're going, whole life insurance, isn't that just protecting you if you pass away, right? It just gives a check. I chatted with someone earlier in the week and they said, well, whole life insurance, doesn't that just send money for people so they can, afford the burial or the cremation? And that is true. That's true about life insurance. But see, whole life insurance is the only insurance product that actually works very differently than all of the others. Okay, I'll prove it to you, everybody. So stay with me here. This is very, very important. I do not care what type of insurance you are familiar with. Let me help you. I know that there's car insurance and travel insurance and vision insurance and health insurance and dental insurance, and you can get pet insurance and you can get travel insurance. There's so many insurances, so many. But here's the key. All of those insurances, in fact, every single insurance except for whole life, only pays money if the bad thing happens. Think about it. If you're holding insurance from one of the major car insurance companies, State Farm, Progressives, the Geicos, you're not getting a check from them. There's no guarantee you're getting a check. You're only getting the money if the bad thing happens to your car, right? If the bad thing happens to your vision, then you can use your insurance. If you're hurt at work, then you can use the disability insurance, the workers' comp, whatever they want to be. Does that make sense? Whole life insurance is actually the only insurance policy that guarantees a check. All right. For all of those who are asking in the chat, put those questions, if you have them, put them in the Q&A section so we can make sure that we come back to them. But here's my question for you guys in the chat. How long do you guys think that whole life insurance lasts? All right. Not a play on words. How long do you think whole life insurance lasts? Put it in the chat for me if you would. Arthur says a lifetime, and I love that one. That's exactly right. I told you first that we're going to talk about why we're using whole life insurance. And the reason for that, first and foremost, is because these folks have used whole life insurance. I probably do not need to give you very much of an introduction to these people. You know who they are, right? Our first circle there, Walt Disney. Believe it or not, he had to use money from his whole life insurance in order to fund his dream of Disneyland or Disney World, whichever one came first. I always get confused, right? And the reason for that is, believe it or not, if you go into a bank and you ask for a bunch of money so you can start a theme park where people are going to wear costumes and cartoons, the bank laughs at you and they think, no, I'm probably not giving you money for that, right? Disneyland. Thanks, Tony. Disneyland's first. These other circles, you can totally recognize some of their names. Ray Kroc is another famous one, right? He used money from his life insurance policies, actually, to purchase the ice cream machines. And if you don't know the story of Ray Kroc and McDonald's, he was in the ice cream business before he met the McDonald's brothers and started to go into business with them and things like that. I know what you're thinking. You're thinking these people on the screen are so old, right? What about the new? Are any anyone new or anyone young using this method? Well, what about these guys? You probably recognize some of them. One of my favorites that we talk about from time to time are the first two. So Jim Harbaugh, if you are a big football fan, you'll probably recognize him. He was a football coach for Michigan. He's now a football coach in the National Football Association or League. But while he was at Michigan, there was an entire ESPN article that came out that talked all about how he was paid from that school using whole life insurance. That's where they got the money from to pay him. It's on ESPN. Sam Walton, he's our Walmart founder, right? Up until about 1988, they purchased whole life insurance on every single employee that ever signed up for their benefits plan or package. It's crazy, right? Think about how many employees that was. It's actually really, really prevalent. You just might not have known. The very last circle is important too. Your conventional and traditional bank, the bank that you use, yes, I promise you, the bank that you use actually owns more dividend paying whole life insurance than they own in land and buildings combined. It is their most valued tier one liquid asset. In the bottom corner of this slide, you'll see US bank locations. Feel free to look it up if you'd like to, but here is the amount in billions, that's billions with a B, your favorite bank or the one that you've used or heard of at least owns and bank-owned life insurance. They call it BOLI, bank-owned life insurance. You can also search COLI, company-owned life insurance. Whole life insurance as income protection that offers guaranteed growth is actually one of the most prevalent things when it comes to banks, insurance companies, and on the individual level. Somehow, some way, we got it twisted and we thought, no, whole life insurance is just for when you're gone. And that's what I'm here to kind of walk you through today, exactly how this works and why it's so cool, why it's so amazing. So here's one of the best ways that I have determined to explain whole life insurance. It took us 3, 4, 5 years to put this together so you could understand exactly how this works more like a bank, like the book is called, than it does anything else. So everybody stay with me here. When you purchase life insurance or any insurance for that matter, you need to pay a premium. That's actually what the bill is called. I don't know if you've been paying attention to your phone insurance or to any other insurance that you have, but every time you pay that bill, it is called a premium. And in the insurance world, anytime that you give an insurance company premium, the insurance company offers you a benefit. Right? I grew up Baptist, so I like to use alliteration. So sometimes I say they offer you peace of mind. They offer you protection. They offer you a piece of paper. They offer you a policy. I can keep going if you like me to, but they offer you a death benefit. You paid a premium. They offer you a death benefit. This is specifically life insurance. If it were car insurance, you'd pay a premium. They'd offer you a benefit on the car. If it were health insurance, you paid a premium and they'd offer you a benefit for your health. Right? See, but whole life insurance is a lot like owning something than it is renting something. It's more like owning something than it is renting something. Here's what I mean by that. If you were to rent a house, you understand that with every rent payment, you're just living in that house for a certain term, right? The rent could change after that term. You don't really have any ownership. You're building no equity. You're subject to the landlord and what their rules are because you don't own it. See, but when you own a house, every time you make a mortgage payment, more of the full value of that house is paid for, paid off, or bought. See, whole life insurance works the same way. Every time you make a premium payment, more of that death benefit that is guaranteed in whole life insurance to be there for your whole life is paid for, paid off, or bought. And the insurance company lists that as cash value. See, cash value is liquid, meaning you can get it. No credit check, no approval process, no loan process. Cash value is guaranteed, guaranteed to be there, guaranteed to grow each year because of the policy that it's built inside of. And so you've got access to then borrow that cash value. This is a very key word, borrow the cash value. Here's why it's a borrow. You haven't passed away yet. Everybody with me? The death benefit is where the cash value came from. Cash value is just the equity today of the payout one day, right? The equity to pay today of the payout one day. That's all cash value is. And so when you ask for cash value early, the insurance company will loan it to you because it's not officially yours yet because you haven't passed away. That means you've got the ability to borrow that cash value if you'd like. It's a loan. Your death benefit would then reflect what you've borrowed. But here's what's important: that premium deposit where you've placed your dollars for paying the premium, paying the bill in this policy have not been interrupted. And inside of properly designed dividend paying whole life insurance from a mutual company, insurance companies guarantee interest earning and dividends, kind of like bonuses, on all of the dollars that you've paid in premium cumulatively over the course of that policy's lifetime. It gets really cool. Let's talk about our third eye, interest, right? Interest. Okay, how many of you understand interest? Do you remember Einstein's very famous quote that says, compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Right? Has anyone ever heard that before? If you've heard that before, put it in the chat. I see Kenneth said yes already. Anyone else heard that before? Yes, a lot of yeses. Okay, I love it. Let's talk about interest for a second, because in the book, Becoming Your Own Banker, the author talks about how people do not actually understand the interest equation and which way the interest is working for them. I found that to be true, and it absolutely applies when talking about using the money inside of a life insurance policy. So let's do a little bit of example here. Hopefully you guys can see on the screen, I've got 3 calculators, and it's a little bit of an example, a car purchase example. In the very right calculator, I'm going to spot you guys some money. $50,000 in your savings account at the bank. That is your bank balance. Okay. And at this bank, because maybe I'll be the banker for you. Okay. And I'm a nice guy, I'm going to offer a 4% annual interest rate. Now you're thinking, woo, I would put all my money in that bank because the traditional banks are giving me maybe 0.04, right? And I totally get it, but this is my made up bank, so I get to offer you 4%. All right. So here's the example. You are interested in a brand new car. And in this particular example, you're just going to go and pay for the car in cash. $50,000 car, $50,000 in your bank. You're just going to go get it in cash. So you walk in, you go to the teller, you say, hey, I'd like $50,000. And I overhear you because I'm the banker. I've got the office or something, right? And I come running up and I say, hey, you were on the webinar. I'm so thankful to see your name again. That's awesome. But don't withdraw your money. Don't do that. Let me just loan you the $50,000 instead. And you say, Jonah, I totally understand that. I mean, that's your business. You're a banker. You're supposed to offer me loans. Like, you'll get fired if you don't. I totally get it. But no, thank you. I'm just going to withdraw the money. I'm going to go get my car. I don't want any payments. I want to be one and done. I want to get my car, drive home today. And I say, no, I totally get that. But you've got a great rate at my bank, 4%. 4%. Let me loan you the money. Leave your money in the bank. I'll loan it to you instead. And your one question that you're probably wondering if you were interested in taking the deal is, well, what in the world would the interest rate be? So I'll put that on the screen for you, 6%. If I loan you the money, you'll have to pay me 6%. Now, here's my question for the group. So get ready for the chat again, everybody. Would you take the deal? If I said, no, don't withdraw your money. Don't do that. Let me loan you the money at 6%. Well, oh, but don't worry. I see you're a little nervous about that. You'll actually come out on top. You'll be fine. Would you take the deal? All right, Adam says no, Kenneth says no, Chris says no, Bill says no, it's a 2% cost. Lex says no, Jay says no. I love it. Okay, so Bill said it was a 2% cost. Bill, you actually jumped, you jumped ahead. That was my next question. Why wouldn't you take the deal? And you've already answered it. Bill says he would not take the deal because he's only earning 4 while he's paying 6. That means he's losing 2. Or Bill says it's a 2% cost. Wouldn't take the deal. Does everybody agree with Bill? Put it in the chat. Wouldn't take the deal. If I'm earning 4, paying 6, I'm not going to make it. That's not good. I see a lot of yeses. People are agreeing with you, Bill. I like it. Now, John says no. So here's what I want to do, John. There's only 4 numbers on the screen. 2 of them are the same. So maybe we could just do the math on this one, right? I've got it put into calculators already. I was trying to give you hints. Let's do some math. If we were to do that math, see, we'd need a term, a length of time. The average car note right now in America is 6 years, 72 months. Okay. If we put 72 months on the car loan, that means our monthly payment would be $828.64. We throw that into our middle calculator, our future value, 828.64, times it by 72, means our future value is $59,662. Let me stop for all those who are not that great at doing math in their head real fast. That means your car was $50,000, but you gave $9,662 to the banker. That was interest. You paid for it. Now, surely you guys have financed cars just like this before in your past, right? You finance a car, that's how it works. You pay the car cost and you pay the extra on top of that. Well, if you would have left your money in the bank, which is what I offered originally, for the same 72 months, you would have finished 6 years later with a bank balance of $63,256. And I don't know about you. I don't know where you are watching from today. I'm in South Carolina where I live. And I got to tell you, they told me that 63,256 was a bigger number than 59,662. But a lot of you in the chat said I would not take the deal. And my question for you then is, what in the world do you miss? What did you miss? What did you miss? Think about it. We bought our car, $50,000. We paid the banker $9,662. And if we would have left the money in the account, we would have still had almost $3,000 excess that we made. What did we miss? Terry says it appropriately. Compound interest is what we missed. See, what we're trying to teach you, which is opposite to some of the people that you might have heard from before on the internet, some big personalities, right? There's a person on the socials these days that tells you to buy everything in cash. And they say you should do it like that because then you save up to buy your thing and then you pay for your car, right? You've paid it in cash. You don't have any debt. And then you save up to buy maybe your house and you pay for it, pay for your home. You pay it off. And I started to realize that if you're a cash purchaser, every time you spend the money, you're just going back to a median line of zero, right? Zero. Super interesting. Well, this person on the internet says you should do it this way because the opposite way is actually a lot worse. See, if you go into debt, you've got to work really hard to get out of the debt for that car. And if you go into debt for the house, you got to work really hard to get out of that debt for the house. Maybe you go on a vacation, you got to work really hard. And I started to realize that even if you're a debtor in this example, you're still working really hard to get to zero. See, but what we are trying to teach you today is that instead of doing the savings or the debt spend way, you should do what we like to call sometimes our save and spend system. See, if you can utilize the liquid, always available, unrestricted, and private cash from a life insurance policy, while your deposited dollars have guaranteed interest and are guaranteed to grow, then what happens is every time you go back to make another purchase, go back to your pool in order to grab more cash, you can do something, there's more there than there was last time. And we think that is an absolute amazing place to be. So let's talk about that fourth eye, investments. Now, you probably know by being on this phone call that one of the biggest things that we like to do with our cash value is use it in our income snowball. That is an amazing place to go get the money so you can fund your fast burning fuel, your short burning fuel. It's amazing. But here's what you've got to understand. And if you're practicing the income snowball, you're totally going to get it. And that's exactly how a bank works. 10 years ago, this is the set of slides, 2 slides that I'll show you here that changed it for me, changed the trajectory of my financial education, my financial awareness, my financial life. And I'll do them with you real fast right here. We've got a bank in the center of the screen. This is your everyday conventional bank, whichever one you like to bank with, whatever credit union you like. And let's pretend that you're going to put $100,000 over the course of a year or all at once right into that bank. And this bank's going to offer you 4%. Okay? Here's what I want to ask you. This is for the chat, everybody. Right now, with what you see on the screen, is the money that the bank has a liability or an asset to the bank? You drop the money off at the bank, and then now that the bank has it, is it a liability or is it an asset to the bank? with what you can see on screen. Okay, I've got more assets than liabilities, I think, so far. I got some liabilities coming in. The correct answer, everybody, is it is currently a liability to the bank. Currently a liability with what we can see. The reason for it is because the bank owes you 4%. They promise you 4%. They owe you $4,000 on $100,000. It's a liability to them. Robert Kiyosaki said liability takes monies out of your pocket, and that's what is happening currently. So what in the world does the bank do to turn that liability into an asset? There it is, Arthur. I love it. They lend it. You guys have probably in your past, or you know someone who has gone to the bank and gotten money for a house. Now here's where it gets tricky. You ready for this? You go to the bank and ask for money for the house. They upcharge you. They put interest on it. You then give the money for that house to the seller, and the seller puts the money where? Right back in the bank. Maybe the same branch. Maybe the same day. The bank might have been without this money for an hour, but now they've got 30 years of payments, right? And that's where they're going to make all their money. Anyone in the chat ever gone to the bank and got money for a car? So excited, going to get that new car. That's a BMW on the screen, right? And then you give all your money to the car dealer, and the car dealer houses their money where? The bank. What about money for a home remodel? During COVID, everybody, right? Remodel the house. We got to get a swimming pool because we got to get these kids outside, right? So you got to pay the contractor. The contractor puts their money in the bank. What about debt consolidation to pay off some credit cards, maybe put their money in the bank? Okay, I've got some numbers on the screen. You guys ready for this? If the bank promised you 4, but they did a deal for 7, how much does the bank get to keep? 3. They promised you 4, but they did a deal for 7 on the house. What about if they promised you 4, but they did a deal for 8? How much do they keep? 4. Promised you 4, but they did a deal for 9. They keep 5. Promised you 4, but they did a deal for 12. They keep 8. They promised you 4. They did a deal on your money for 3, 4, 5, and 8. They kept 20% on your money. You made 4. And this is a great bank, right? They kept 20. You made 4. What percentage more did they make than you made? Put it in the chat. What percentage more did the bank make than you made on your own money? I see a lot of 16s, a lot of 16s. Paul McHale, you are correct, sir. The bank made 500% more on your money. If I put real numbers to it, it'll make sense. If you put in 100 and the bank owes you 4%, that's 4,000. If they made 20%, that is 20,000. And surely 20,000 is not 16% more than 4,000, right? That's how that works. The bank made 500%. Here's the most important question for everyone who's paying attention out there in chat land. How much risk did the bank take by doing these deals? How much risk did they take? Very, very, very limited. If you were risky, they made you sign different paperwork than the person that wasn't risky. If you were too risky, they didn't loan you the money at all. Some of you have cousins like I have cousins. They're not getting loans. Not happening, right? That's how that works. Who has paperwork on every house, every car, every transaction in your town? Who is in control of the money around you? The bank. You guys got it exactly correct. That's why we want to teach you to become the bank. And we do it through dividend-paying whole life insurance through a mutual company. We borrow from it and we use it in order to build wealth. You can use it, of course, in lieu of a credit line for your income snowball, which is actually one of the things that I've just started doing because I was introduced to the income snowball recently, and I think it is a perfect match with exactly what we do, teaching you to become your own banker. Tanisha's going to talk about that in just a second. I'm going to skip these for time's concerns, and we'll talk all about them in a little bit. But here's what I'd like to offer you guys here. On the screen now is a QR code. If you take your phone out, take your tablet out, whatever you've got, and you scan that, you can absolutely book a call to talk to one of us, free call, talk to one of us specifically about your situation, about how you could possibly be your own bank, about your numbers, your values, and see how it can work for you. I've also heard that a significant amount of you already utilize whole life insurance, maybe, for your income snowball. And so you've got policies that you'd actually like us to review. If that's you, book a call. We'd be more than happy to review that for you so you can understand how to use your policy or how your company works or exactly how much cash is in there or anything like like that. And we would be more than happy to do that. So this is your QR code. This is the code where you want to book. If you want to talk to me, it's this code, right? This is how you get us so we can walk you through becoming your own banker and marrying that specifically with the income snowball. Tanisha, I'm going to pass it back to you. It's all you.
Wow, that was awesome. I love that. Actually, do I even need to talk now? I think you like kind of covered almost everything. But no, this was awesome for sure. Let me see if I can share my screen here. All right, so let's see. I don't think I'm sharing just yet. Okay, there we go. All right. Okay, let's see if you guys can see my screen. Okay. Let's see. Are you guys able to see my screen?
We gotcha.
Perfect. All right. Okay, I'll jump right in. I'm going to go through this really quickly. Some of the things that I'm going to talk about, Jonah already covered. So I'm going to go through that kind of quickly, but I want you to see how powerful investing is when you use your bank, your own bank. So for those of you who don't know who I am, my name is Tanisha Souza. I'm the CEO and co-founder of Tardus Wealth Strategies. We've been in business for over 20 years. A+ rating with the Better Business Bureau. We've been featured on all kinds of different media outlets. And so that's kind of my really quick introduction. All right, so let me just give you a disclaimer. I am going to be talking about investments, but I want you to know that we're not in cahoots with any type of investment platform or fund manager. We're investment agnostic. So we don't care what you invest in as long as it works. And we want to make sure that you know what it is you're doing when you invest. We're a financial coaching and education company, and we don't earn commissions or referral fees from any financial vendor ever. It's not a get rich quick scheme or like a magic wand that's going to eliminate all risk when you invest or guarantee that your investments are going to grow beyond belief. What we do is we help you build what we call an income snowball through education and action. So I'll show you how to do that right now. Now, in order for your money to grow, you have to use it. Jonah talked about this, throughout his presentation. You can make money buying things like, basically using that money multiple times through your own bank. I'm going to show you how to turn sleeping cash value into 5,000 plus without Wall Street risk or becoming a landlord. And so, what I want you to know is that if you already have a policy, you want it, and with cash value, you're going to want to use it in a very specific way. Now, Jonah gave you examples of using your policy to buy yourself a car and pay yourself back. I'm going to flip the script a little bit on that. So we're going to show you how to turbocharge, right, that life insurance policy. And instead of buying something that costs you money, like a car, we're going to show you how to buy things that pay you money on a monthly basis. How many people on this call, on this webinar right now, are interested in learning how to make money with your life insurance policy? Give me a thumbs up if that's something you're interested in. All right. Awesome. All right. Janet, awesome. Good. Okay, now, after 25 years of doing this, right? So I've been an investor for 25 years. I'm an author. I've been coaching investors for, over 20 years on how to invest. I've done a lot of things right and I've done a lot of things wrong. And I want to tell you a little bit about what I've learned about investing. Number one, these are different mind shifts. There's a right way and a wrong way to invest, right? To grow your money. And I'm talking about the long, slow, hard way that most people try to do it, thinking that they're going to build up millions of dollars in a savings account over, by the time they're 65, right? So there's a right way and a wrong way. And I'm going to show you the right way. Number two, avoiding debt is good, but avoiding leverage is not, right? Jonah alluded to some famous figures who are telling you to pay for everything with cash. And so I understand why people are afraid of debt, but what they're not understanding necessarily is that leverage can be very effective, especially when you're using your life insurance cash value. And the third thing is when you have a blueprint plus a coach plus a team. In other words, experts that can basically provide you with those tools, like your life insurance, like a properly structured life insurance policy. It makes it absolutely foolproof. So I'll explain that. Okay, so let's talk about the first lesson that I learned, which is that there's a right way and a wrong way to invest. And there's a very specific way that we're going to teach you how to do it that's going to maximize your cash value. So again, today Jonah gave you the example of buying a car with a whole life insurance policy or a home. And obviously it's better to buy those things with your life insurance policy than going to a regular bank, right? That's better than borrowing from your friendly neighborhood bank. But what if you used your cash value differently? What if you bought assets instead of liabilities? And some of you may think, well, my house is an asset. Well, at Tardus, we consider assets those things that pay you. And so I'm going to go into that as well. We want you to focus on buying assets. Assets create income for you on a monthly or quarterly basis. So we don't consider your primary residence an asset or your car an asset, right? Unless you Turo your car or something like that. It's not an asset. But liabilities are things that take money from your bank account or your pocket every single month or quarter or yearly or even just once, but it doesn't make you anything. So instead of using your life insurance, your cash value to buy liabilities, you can let your assets that you're buying pay for your liabilities. So this is what my husband and I did for years. We ended up buying multiple properties. We bought a strip mall before we bought our primary residence. And the income from that strip mall paid for our dream home, right? Isn't that better than using the money from your job to and borrowing the money to buy your dream home? And then you have to work to pay that loan off. Our assets actually do that for us. And so we'll get into that a little bit more. So the second thing, the second part of this lesson about the right way and the wrong way to invest is you want to buy assets that give you more control, right? The more control you have, the better. And by control, what I mean is control over the rate of return, right? You choose what rate of return you want when you invest. Also, the risk level of that investment, right? How risky are you willing to go, right? Some people have a very low risk tolerance, so that's important. So you want to actually have control over the risk of the investment and how often you get paid and the safety and return of the principal. So those are things that give you more control. The more control you have over each of those factors, the less risk it is for you, right? Some people, the same investment may be very risky for them opposed to someone else. And that's because they understand the rate of return, the risk level, and they know how to adjust it. Here's another thing. You want to buy assets that give you more cash flow, right? And everybody knows what cash flow is. And by cash flow, we're talking about focusing on cash return. And for those of you who are new to investing and maybe you don't know what cash on cash return is, what it is, it's the annual cash flow you receive from the investment that the investment pays you divided by the total cash you invested in that investment. So, for example, if you were to buy a property and it cost you, maybe it was $100,000 property and you were able to put $10,000 down, which is ridiculous. I mean, you're never going to be able to do that most likely. But if you could only put 10% down on this rental property, that's the $10,000 you put down is your cash outlay. But the amount you get back from that investment every single month over the course of a year, that is what you receive. So if you got $1,000 a month from that investment, which, for an entire year, that would be $12,000 divided by the $10,000 you put in. That would be a humongous return. You would get that would be 120% return, cash on cash return, which is not really likely, right? It's usually going to be like $100 or $200 a month on a rental property, but like that. But the idea is to understand cash on cash return. The higher the cash on cash return, the higher your cash flow. And the more control you have, those are the types of investments you want to look for, and we can show you how to do that. Now, let me give you an illustration on something that I'm sure you've all used and you all understand. So let's say that imagine you're buying a refurbished ATM machine And in one of the buildings that my husband and I purchased years ago, it was an office building with a food court at the bottom. We installed an ATM machine on the ground floor. During the day, people would go there and they would use the ATM machine over and over again. And it was a cash cow. It was like a genius move. Now imagine that you bought a refurbished ATM machine for $2,200, or not very expensive these days, and you found a good location like a convenience store, 24 out, open 24/7. And you installed the ATM machine in that place. And so you use $10,000 of your savings. So I'm going to ask you this. I want to know, would you use $2,000 to buy that ATM machine? Use $8,000 from your savings. So you have $10,000 in savings. You're going to use it all. And you're to earn $600 every single month in fees, in ATM fees. Okay, I want you to think about that. What is the cash on cash? First of all, would you do it? Right? You're using $10,000 of your money, you're investing of your cash. Okay, we're not talking about leverage or anything yet, or using your life insurance policy, just cash. Is it worth it to take 10,000 of your savings and then you're getting $600 a month every month? That's $7,200 you're making over the course of a year. Divide that by $10,000. What's the cash on cash return on that? Who knows what the cash on cash return is? Let's see. Anyone know? That's right, 72%. 72% cash on cash. That's not bad. Okay, that's huge. Think about it. If you're going to take $10,000 and you're going to invest it in the stock market or some other thing, you're not going to get 72% return. Like that's unlikely. So that's a high cash on cash return investment. Not bad. Okay, but I'm going to show you something even better than that in just a minute. So let's talk about the next lesson that we were talking about. The first one was there's a right way and a wrong way to invest. Again, you want more control. You also want more cash flow. The second thing is avoiding debt is good, but avoiding leverage is not good. Okay. What's the difference between debt and leverage? Anyone know? Anyone know the difference? Okay, well, let's see. Borrowing to buy an asset is leverage. Borrowing to buy a liability is debt. And remember, assets are things that put money in your pocket. Liabilities are things that take money out of your pocket. If you make a car payment every month, that's taking money out of your pocket. If you're making a mortgage payment on your home, that's taking money out of your pocket. If you're investing in something like an ATM machine or an investment that pays you every single month, rental property or a fast burning fuel investment, which I'll talk about in just a minute, then that's an asset. So using a mortgage to buy a house to live in, right, your primary residence, that's debt. Using that same mortgage to buy rental property is leverage because it makes you money. So making sure that you understand the difference between leverage and debt is huge. This was one of those, mind-opening things for me because I was doing it the wrong way. And in fact, I had even used my life insurance policy, my whole life insurance policy to buy liabilities. I had done that, right? Those are some of the things that I could have done better. And so I'm going to show you what to do. Now, let's take that step further. We're going to go back to that ATM machine example. Now, instead of you doing what I just said, which take all your savings. Let's say you took $2,000 of your savings to buy the ATM machine, but you borrowed $8,000 from your policy because maybe that's all you had, $8,000 cash value in your policy. If you do that and you earn $600 every month, okay, and if you have your phone, do the calculation on this. $600 times 12 months is $7,200 minus, say, $200 in interest on the loan, which probably wouldn't even be that, but let's just say we take out $200. So now you have 7,000 is your cash that you get back, right, from this investment because you borrowed from your policy, right? 7,000 divided by the $2,000 you put in of your own cash. What is the cash on cash return on that? Does anyone know? Anyone do the math on that? 350%. That is the cash on cash return because you used leverage on an investment that pays you. That is insane. Now, how many of you would prefer making a 350% cash on cash return over a 72% cash on cash return? How many of you would like that? Okay. Just a few. Okay. Right. All right. So yeah. So what I'm saying is what you want to do is strategically use leverage. People don't have a problem borrowing money to buy cars and homes and things like that that actually take money out of their pocket or vacations. Like he was saying, they don't have a problem with that. They don't think that's risky. But honestly, it is, especially in today's environment where we see with AI coming out and everything else that there's a lot at risk, right? If your sole source of income is your job, that's something that you have to look out for and be aware of. A lot of jobs are already going away. So we want to make sure that you have other streams of income coming in and not rely solely on your job. Okay. All right. Let's look at a couple case studies real quick before we get into the third lesson. Right. First is Wayne Oshima. Now, he came to us back in 2005, believe it or not. So he was a client in 2005. He retired in 2011. So he started with $500 cash flow and he was a government employee, had a very small, like that's all he had left at the end of the month. Cash flow at the end of the month was $500. That's what he was using for his income snowball and to build his investment portfolio. He only owned liabilities. He had, I think they had two cars and his primary residence. So 6 years later, he had $8,200 in monthly cash flow from all of his investments. He owned two apartments and fast burning fuel assets, paying him $8,200 a month. He also, if you watch his testimony video on our YouTube channel, told us, which we didn't know until he was telling us on this at this meeting, that he took $50,000 and gave it to his daughter as a wedding gift so she could buy her first home, and so he was able to do all of that with the income that he had created through the income snowball. Now, here's another case study. We have Sharon and Chris Bartels. Before, they had $3,100 cash flow from one rental property. So they have one rental property that was free and clear. And so they also owned their primary residence free and clear, and they owned some cars, but they had a construction business and they were tired. She was like, it's a dirty, nasty business, and I want my husband out of it. I don't want him around all those chemicals and everything else. So we want to be able to shut the business down. So they were able to do that after 3 years. They generated $44,000 in monthly investment cash flow. They owned assets equal to 14 single family rentals, fast burning fuel assets, quit the construction business, moved to Texas to be with family. It was amazing. Both of these examples, both of the clients that I just shared with you, use the strategic use of leverage to buy the right investments in the right order at the right time. Okay. Now, let me get into that right order, right time, and the types of investments in just a minute as well. All right, I know this is a lot, so just, like I said, this is like drinking from a fire hose, but just pay attention because I have something that I want to share with you at the very end of this. I think you're going to find super, super valuable. Lesson 3 is a blueprint plus coach plus team equals foolproof. That is avoiding mistakes. I don't know about you, but I'm all about shortcuts. I don't like waiting in lines. I will, when we used to go to amusement parks, I haven't gone in a while now, but I would be infuriated if I had to wait in line for 3 or 4 hours just to ride a, 1.5, 2 minute ride. I would rather plan ahead, get one of those fast passes, pay extra, and go to the front of the line, right? How many people would rather pay for that convenience to skip the line? I like shortcuts, right? Yeah. I like that. I mean, I would prefer to learn how to do something that someone else did without bumping my head and just really not understanding what I'm doing and making mistakes and errors and just wasting time. To me, the most valuable thing we have is time. It's not even money. Money is great to have, but time is the most important thing. And if I can buy more time, and that's what I'm doing, right? When I'm paying for that fast pass, if I can buy more time, that's what I'm going to do. And that's a shortcut. So when you have a blueprint, when you have a coach, and when you have a team, right? A team like your insurance specialist, someone that's going to make sure that you have the right policy and your whole coach and your team, they can help you invest using your life insurance policy. You've created a foolproof system. And so that's what I want to share with you how to do. So think of the income snowball as a passive income generating machine. That's what it is, right? An income generating machine. It is a 23-year-old system for teaching you how to build passive income faster than you ever thought possible. And it's patented. I patented in 2014. So we actually started teaching our clients this while the patent was pending. And in 2014, we got the patent. So it was about 3 years after Wayne Oshima retired. And so we have a lot of examples like that of people being able to do this. Like I said, everybody's individual results will vary, right? You're not necessarily going to do the exact same thing Wayne did. You're not going to do the same thing that Sharon and Chris Bartels. Every single person is different. And that's the reason why it's so important for you to see what your specific blueprint is. Now, let's talk about the order of this and how this works, how you would need to, the specific way to invest. So remember when I said the income snowball is a system that requires a very specific investing in a very specific way? Here's what I mean. First, you need to have some cash flow. Okay, that's your personal cash flow from your job or your business or whatever it is that you do. And if you already have investments, great. Maybe your cash flow is coming from that, right? So you have to have that. That's the spark that gets this whole thing started. An extra $800 to $1,000 left over at the end of the month is all you need. And in a lot of cases, like Wayne, who only had $500, we were able to find him extra money that he didn't even know he had, right? And I know Jonah's an expert at that as well. So, second, you need fast burning fuel investments. Now, that's the kindling that powers up what you're trying, this fire that you're trying to start with your investments. Now, these are short term investments that are amortized and have a high cash flow and a high cash on cash return. They give you fixed monthly payments over 2 to 5 years typically. Remember when he gave you the example of what you would pay monthly for a $50,000 car for over 6 years? It was like 800 something dollars. I was like, oh my gosh. I mean, I haven't had a car payment in a long time, so that just sounded like a lot to me. $800 a month for 6 years for a car for $50,000. But the idea is the shorter the term of these investments that you're making that they're paying you these fixed payments, the bigger the payment, right? That's the reason why they extended. Before, car payments used to only be for 5 years. Now they're extending out to 6 years. Why are they doing that? Because people want to get better, nicer cars, and yet they don't want to pay $1,000 a month for a car. So they have to extend, make the amortization schedule, the term of that loan longer, right? If they made them 10 years, people would love that. I mean, that's kind of crazy because your car won't even last that long. But it's 2 to 5 years. If you shorten the term on an investment that you're making money on, that's more money to you. You're getting huge payments for a very small outlay of cash. And then the third is you need slow burning fuel. And you need to do them in this order. These are the big logs that make the fire last. These are long-term investments like rental properties, mortgage notes, ATM machines, investments that can pay you for 30 years or more. And when you invest in this order, right, your income snowball grows faster and can last for the rest of your life. And now you don't have to put any money in, and it's just feeding you and your family for the rest of your life. Now, doesn't that sound like something you want to do? And if you can do it where you don't have to go to a physical bank and get them to approve you for a line of credit, and you can use your life insurance policy, it makes it that much better. Now, let me walk you through the income snowball and the mechanics of it real quick. The income snowball uses leverage that you pay back with a combination of your personal monthly cash flow and your investment income. So the first thing we do is we use that line of credit. I have a credit card example here, but you would actually use your life insurance policy to purchase an income producing asset. And I'm going to show you exactly what Wayne Oshima did. So you use that leverage, you buy an income producing asset, and then the income from that asset that you get every month, plus your personal cash flow is used to pay that loan back. So in this case, your policy loan will be paid back with your cash flow and the investment income. And guess what? You know how much income you're going to get every month if you're buying a STI investment, a short-term amortized income investment, a fast-burning fuel, because it's fixed payments that you're getting over 2 years, 3 years, 5 years, etc. Now, that pays off the leverage. You're able to do that in a few months. And once it's paid off, what do? Right? When the leverage is paid off and you're still getting that investment income for another, say, 2.5 years, what do? you use your policy, you borrow again, and you do it again, right? You buy the next investment and you do it over and over again. Now, the amounts you invest, the interest rate that you invest at, when you increase that, all of that is blueprinted out by my calculator, which I'll share with you in a second as well. Now, we call this momentum income stacking because you're investing in assets that produce that monthly income. And by doing this over and over again, you create that stacking effect. So, for example, Wayne, what he did was he used a $10,000 line of credit to buy an investment that paid him $320 a month for 3 years. So it was amortized over 3 years. It was principal and interest payments, just like your car, right? But he was getting this money. This wasn't money he was paying to a bank. He became the bank. He was actually getting that money. Now, he wasn't using a life insurance policy. This would have been so much better if he did, because he would have also been able to get those dividends and have the money that he was building up in his policy that would have continued to grow. But he was actually just paying his local bank, which I think was Bank of Hawaii at the time. So he was getting $320, say January, February, March, April. Every month he was getting $320. He used the 320 plus he had $500, but we helped him find, I think it was another $400. So he had 900 plus the 320. So he had over $1,000 a month going to pay back this loan. Now, once he did that, actually, it was more than that. It was more than that. We actually helped him pay off a debt. We showed him how to pay off a debt that increased his cash flow pretty dramatically. We arranged a few other things. So he had over $1,000 a month on top of that. So it was really great. But after he used that, say it was like $1,500, $1,700 a month to pay back that $10,000 line of credit plus the $320, he was able to do that in just 5 months. So by month 5, once it was paid off as 4.5 months, he was able to do it again. Now think about this. His investment never changed. So if he's putting in $1,700 a month, right? That never changed. He kept putting in $1,700 a month. But for the first 4 months, 4.5 months, he got $320 from the investment. And that 320 continued for another 2.5 or 2 years and 8 months, right? He's going to keep getting that money, but he doesn't have any more debt, right? He paid it off in 4.5 months. So what does he do? He makes the second investment, but you can see that $320 continued. Now he's got another $320 for a total of $640 for May, June, and July. So his money doubled, but the $1,700 he was putting in didn't change, right? That didn't change at all. So he continued May, June, July, taking now the $1,700 he was putting in and $640 he was putting in to pay off the line of credit. So do you think it was faster to pay off the line of credit now that he doubled the money that was coming in from his investments? Oh, heck yeah, of course it was. It was a lot faster. So he was able to do it again. So think about it. That first investment, now he's 6 months in and he buys his third investment because the policy loan, or not the policy loan for him, it was a HELOC. His HELOC was paid off and he was able to do it again. So now he's got triple the income. He's got $960, 320 from the first investment, 320 from the second investment, 320 from the third, total of $960. He's getting every single month. Now we know that since he's already about 10 months in to his first investment, he's going to get that first investment is going to stop in about 28 more months or 26 more months, right? But he's going to get this for another 30 months. And this he's going to get for 33 months and so on and so forth. But because the money is doubling and tripling that he's getting from the investment, and why is he getting paid so much on a $10,000 investment? Because it's short term, it's amortized, it's principal and interest. And it wasn't even his money to begin with. He borrowed it. Like it wasn't even his cash. He didn't put any of his cash into buying the investment. He's using some of his cash to pay it off. Now, what happens then? He does it again, the fourth investment, and so on and so forth. Then he increased that from 10,000 to, I believe it was 15,000, and then it increased after that. Imagine having a life insurance policy that was built for the income snowball, where when you need your line of credit to increase, it can increase when the cash value needs to be higher so that you could borrow more, so that you can invest more, that you have it when you need it. That's amazing. And that's what some of our clients are doing. And so I highly encourage you, if you already have a policy, great, especially, if that, definitely use it this way. And if you're new and you're trying to start your policy or thinking about starting it, this is the way to do it. This is the way to build it. Okay. So now that's the income snowball part. But what Tardus helps you build is the machine that powers the snowball with coaching and a team. Okay. So let me go through this really quick. This is how this worked with James. Okay. So James, he had a $6,000 monthly income and he had $4,300 in expenses. His net cash flow was 1,700. Okay. And so he decided to put 1,700 into a snowball. Do you have to do that? No, he could have put 1,000 or some other amount, but he wanted to go fast. Now, what you can see here is he's still putting in that $1,700. That's the income from his job, really, it's just cash flow. And his expenses are in there as well. When he gets to the financial freedom date, right, which is November of 2032, which for him, this was an 11-year plan, his income stops. He can actually quit his job November 1st, 2032, and all of his investments cover his living expenses. You can see his living expenses don't change, but his income stops. So that's November 1st, 2032. His withdrawal amount's 4,300 and his total monthly income is 46 grand. Now, would you like to have $46,000 a month in your portfolio? I would assume so. Now let's look at the total cash flow. Now you can see that he has 46,000 at that time and his investment commitment goes down to zero. So $1,700 a month, but then it stops. And you can see that the asset value is over $500,000 around that same time period. So his assets are growing and he's only at fast burning fuel. There's no long-term assets in here yet. And he also has his income continues to rise. And you see that green right there, that's $1,700 that drops off when he reaches financial freedom. So whatever your goal is, it doesn't have to be retirement. It could be something else. Hey, I need this much money to buy my dream home. Hey, I need money to do this or that. All of those things are doable with the income snowball as well. All right. The benefits of investing in income snowball way. Your contribution is fixed. Whatever you decide you're going to put in your income snowball. And remember, we don't touch your money. We just show you what to do. We coach you through it. You do it yourself. You handle all your accounts. Nobody does it for you. Your contribution is fixed, but your passive income multiplies. This also helps you get discounts on every investment you buy. I don't have time to go into the details of that, but in the example that I showed you with Wayne and the $10,000 investment, he was actually buying those investments cheaper and cheaper as time went on because his fast burning fuel was actually putting more money towards the paying off the investment than he was at some point. So that means he was only putting in, maybe $3,000 to buy a $10,000 investment later, which is a 70% discount. So we're going to show you how to get discounts on every investment you buy, including mortgage notes, real estate, if those are things you're interested in. And if you're not interested in any of those, you don't have to. Right? You can actually do this with almost any type of investment. Education and coaching eliminate the guesswork, math, trial, and error. I don't know about you, but I would hate to sit here and try to figure all of this out. This took a lot of years, a lot of time of development to eliminate the guesswork for you so you don't have to. So learn the shortcuts, invest smarter, and know if an investment works before you buy. I mean, how many of you guys have ever made a mistake investing? Has anybody ever done that? Or am I the only one? Like, has anybody ever like made an error? Like, this was bad. I shouldn't have invested in this. Yeah. Okay. Joshua, all right. Me and you. Okay. So this is the thing. What's nice is this takes the guesswork out and ensures through the due diligence and everything, the criteria that you build in this whole system, that you don't make those types of errors. You will know if it's a good investment before you buy it. It puts you at an advantage when investing. Let your fast burning fuel assets buy your slow burning fuel assets. Like I mentioned before, the short-term investments will buy your rentals if that's what you want, or mortgage notes, or ATM machines, or whatever it is that you want. Gold, if you want to buy that, let your fast burning fuel assets buy that for you. Bitcoin, whatever it is. reduce your tax liability, right? Your fast burning fuel assets can actually help you reduce your tax liability as well. All right, so we're coming to a close here. What I want to share with you is you do have an opportunity to have a personalized income snowball strategy 4-point call. And this is going to show you how to generate investment income as little as 45 days, right? You will see income in your bank, in as little as 45 days. You will see how to change debts into assets, right? Convert that thing, right? Just like we did for Wayne, how to hit your financial goals. And whatever they are, it doesn't have to be, I want to quit my job. Maybe you love what you do. Maybe you love your business, right? But maybe you're going to have to. I mean, I'm seeing people right now. It's crazy, this whole AI stuff. I mean, literally left and right, I'm seeing people whose businesses or jobs are affected by that, just have income, right? So that you can do that. During COVID, we were able to help so many people during that time period when they had no income from their job or their business. We were able to help those people have income to live on that was not the income from their job or their business. So definitely that's something that you want to have in your back pocket. And don't wait. It's not, you don't want to wait. I would start now. You got to get going now if those are some of your concerns. Next steps to implement your plan. That's the other thing you're going to learn with this personalized income snowball strategy 4-point call. You are going to get a demo of the calculator and you are going to get that plan, that blueprint. So here are 2 promises at your strategy session. One, worst case scenario, you leave with clarity. Best case, you're going to shave years off your financial freedom date, whatever that is for you. But your financial freedom may be to quit working, or it could be something else. Whatever that is for you, we will be able to shave years off of that for you. So here are a couple of questions that I want to answer, and we'll get into the Q&A in a second. Some people I know you're thinking, how much cash flow do I need to get started? I would say about $800 a month minimum. And usually if you don't even have that, we can help you find what you need. I mean, we help Wayne find ridiculous amounts of money. We can't do that with everyone, but if you have around that, you should be good to go. If you have more than that, you're going to be able to turbocharge this and go super, super fast as well. And everything you do will be different, right? Every single person's blueprint, their strategy, their plan is going to be unique to them based on their cash flow, their debt, their needs, their goals, everything. Okay, next question. But I don't have any extra cash flow because I'm funding my policy. Well, good. I'm glad you're funding your policy. But guess what? Did you know that your income snowball can be built to fund your policy so that you don't have to fund it just with your cash flow? You can actually help, just like I was saying, where your income snowball can help you buy things like rentals and things like that. It can also help you do both at the same time. You can buy assets and you can fund your policy. We have tons of clients right now who are doing exactly that. Just like we built it to fund rental real estate portfolios, mortgage portfolios, businesses, you can use it for so many different things. So just meet with a coach and see what's possible so that you can find out if the income snowball can help you fund your policy. And in most cases, the answer is yes. What if the interest rate on my policy loan is close to the return of my investment? Okay, well, Jonah already kind of answered this, but when you're looking at the interest that you're paying on a policy loan, most policy loans charge, at least mine does, charges interest in arrears. So you would have paid off the loan 2 or 3 times before the interest is even due on the first loan that you made. So if you invest in fast burning fuel assets, you will actually have doubled, tripled, quadrupled the cash flow before you even need to pay on your loan interest. So that doesn't even matter. But like he shared, if you're borrowing to buy something that has like a car or something like that, you're actually making more money in your bank than on the other side. And what we're doing here is we're actually investing for even higher returns, right? Higher cash on cash, lower your risk. Okay. So I want you to think of this complimentary strategy session we're offering you as firing up the GPS before a road trip. Like we're going to plug in your destination, which is your income goal, whatever it is that you're trying to achieve. Like I said, maybe it's a home, maybe it's paying for your kids' private school. Maybe it's just, hey, I'm not sure what I'm going to be doing in a few years. I have to choose a new career. I want to create more income for that. That's fine, whatever it is. We plug in that information on your goals, factor in the live traffic, your current cash flow, the loan rates, the investments that you choose or that you want to buy and what's available. And we hand you the turn by turn directions, right? We help you walk you through everything, the investment criteria, the due diligence, everything. You're still in the driver's seat. You can only press the gas. You're the only one that can do that. But the route is mapped for you. The detours are flagged and the estimated time of arrival is clear. Okay, that's what I want you to understand. That's what this is for. So you have a choice. Some people in this webinar will choose to forget everything they learned, which, maybe not by choice. It's a lot of information. I get it. Others will book their free strategy session and see if it fits. So I want to make sure that you book your strategy session today, and then we will get into the Q&A in just a second. One more thing, I do want to give some certain people priority because I've been hearing so many things and people are so concerned. And so I want to tell you who's going to jump the line, right? We talked about shortcuts and skipping the line. I think these people need to work with us as soon as possible. I think there's urgency, a lot more urgency here. So people who work in industries most likely to be eliminated by AI. So if you feel you're in an industry like that, I'm sure you've been hearing a lot. We will make you a priority. Individuals whose sole source of income is their job or business, if that's your only source of income, then we will, make room for you and we'll rearrange people to make sure that you get an appointment as soon as possible. People who need more income due to health issues of their own family members, that one, or of their own or their family members. We had a gentleman who he was a chiropractor that needed a kidney transplant, and he needed to create income as soon as possible because he was not going to be able to work during that time, not just during the transplant, but he was not going to be able to work for 8 months after that. So we created the money for him that he needed to live on in like it's a couple of years. Anyone 10 years or less away from retirement age who hasn't saved enough, and those whose existing investments are underperforming or not performing. So if you do have investments that are paying you, but they're just not performing or they're underperforming, we can help you with that as well. That's what we do. We're education, we're coaching on investments. We can help you with that. So it just what you need to do when you book, right? So that this is the strategy session. So go ahead and use that phone, scan the QR code, schedule your complimentary strategy session. When you see those appointments, if it gets pushed too far out and you're looking at weeks, because I know there's a lot of people on this call that want to schedule a strategy session, then what I want you to do is I want you to write this phone number down, 808-440-0688. And I want you to contact our office and say, there was no appointments in the next 3 weeks. Can you fit me in? And let us know that you have one or more of those line skipping things, and we will push you to the front. Okay. So anyway, that's what I want to say. And let's open it up for Q&A.
Yeah, we've been collecting a lot of questions here, so I will go ahead and start from the beginning, which means that the first portion, Jonah, is for you.
Okay.
What if you have an existing medical condition? Can you still get insurance?
Ooh, I love it. That's a good question. I don't want to make sure you guys can hear me. I took the mute off. Okay, perfect. Okay, that's an amazing question. So yes, if you have an existing medical condition, you can still qualify to be the owner of the insurance policy. Okay, you might not be able to be the insured person. Okay, so, and again, let me be clear. You're allowed to have asthma. You're allowed to be just a little bit overweight, right? You need to go on a run, something like that. But if you've got something that's life-threatening, the insurance company will probably say, no, Jonah, you cannot qualify for insurance. You've got cancer. You're on your way out. But that does not mean that I cannot own the insurance policy on my spouse or on my kids. I've got 3 kids, 7, 5, and 2. So I can own them. I use them for infinite banking, fund my Snowball, use it for my short burning fuel, whatever you're doing. But I'm not the insured person. The insured person is a family member or a business colleague. You can get pretty creative with it. So great question.
Awesome. IUL versus whole life, using either to fund my cash value or just whole life, and why?
Yeah, that is an amazing question. So IUL or whole life? The answer to that one, I think that was Arthur who asked that. The answer to that one, Arthur, is whole life and whole life only. IULs are not the same as whole life. They are getting some shine in the marketplace, and people are saying they're totally the same. And the simple answer to it is they are not the same. And it's not the same by like 50 different areas. It's not even like 1 or 2 areas. It's like literally like 20 to 25 areas that it is just not the same. And so you actually, people who encourage IULs will not encourage you to take the cash out. They say, wait for retirement before you take it out, because they know if you take it out too early, you could lose that policy. So we don't do that at all. We're going to do whole life. And again, that was just one of the reasons. Good question.
Awesome. I think that you mentioned this at the beginning, but someone asked, does it expire after a certain time, like other similar policies?
Oh, that's a great question. So does your whole life insurance policy expire? The answer to that is no. Whole life insurance policies last for your whole life. There are term life insurance policies that do expire, and those do not build any cash value. So that is not what we want to use for infinite banking or to fund things, right? You got to use whole life. So nope, no expiration date.
What if you don't have any relatives to name as a beneficiary? Can you still get insurance?
Okay, I see this one. This one's from Kenneth. Kenneth, all right, you see, I'm looking pretty good, man. If you want to put me down as the benefit, no, I'm just playing. Okay, so you can leave the money to your family, friends, no friends, church, no church, charity. All right, you can leave the money to whoever you want. And if you still are telling me you've got no one after that, then I'll tell you my favorite charity. We'll leave the money there.
Awesome, thanks. Tanisha, how can you use the income snowball to pay off debt, and how does it compare to the debt snowball, velocity banking, or using a cash value policy?
Yeah. Well, we're talking about using it with your cash value policy, but if you were to use it to pay off debt, right? What we do is we do what's called a debt split. So we would take your policy or your line of credit and we would split it. So sometimes it's a 70-30, 60-40, it could be 50-50. It really just depends on maximizing cash flow, how to maximize the cash flow. So our calculator will determine that. So then once we figure out what the ideal split is, then that line of credit, let's say it's $20,000, maybe if it's a 70-30 split, 70% of that 20,000 will go towards either fast burning fuel, and then the other 30 will go towards paying down debt. And then the income from the investment and the cash flow that you get paying off that debt will help you to, again, pay it off faster. So we used to do what's called it wasn't the debt snowball, but we used to do a mortgage acceleration thing where you would use the line of credit, you'd pay down a mortgage or you'd pay down some other kind of debt, and then you'd use your cash flow from your personal cash flow to pay it down. And that worked fine. But the only problem with that is if your cash flow goes down for whatever reason, it stopped working. So if you had some big expense, or you lost a job, or there was an income loss in some way, you basically had to stop doing it because you would be getting further into debt on your line of credit. And back then, I think most of our clients were really using like home equity lines and things like that. So the problem with that was it would stop working. So people would be like, I can't do this anymore. With the income snowball, because you're creating income with every single time, with every flip, we call it a flip, every investment you make is a new investment that brings in more money, doubles, triples, quadruples, whatever the income that you're getting, it helps you pay off the debt. So that's what it actually overtakes the cash flow you're putting in to pay the debt off. And at some point it like switches. So now you've got, $40,000 a month coming in, paying the debt off if, your debt's that big, or what have you. And it's just phenomenal. It's way faster than anything I've ever found if you're trying to pay off consumer debt, cars, mortgages, rental properties, whatever you're trying to pay off. But my suggestion right now on that is to not worry about debt so much. I do think that, and I've mentioned this a couple times, I do think AI is a disruptor. So I do think that people should focus on creating income right now. I think if you have debt, create enough income to cover your debt from your passive income so that everything's paid for. That's what we did with our strip mall. We had enough passive income from our investments that covered all of our expenses, all of our eating out and everything, including our dream home. So that if we lost our job or if something happened with our business, we had enough money to cover our mortgage payment. So that would be my suggestion with what's happening right now, in the world, and things are shifting so quickly that would be my suggestion. But if you really, really, really want to pay off debt, or you need to for some reason, this is the fastest way to do it.
Awesome, thanks. I've got two questions that are kind of similar, asking about should we use a line of credit, should we use a HELOC, or should we use a whole life policy? What's better for their snowball?
I like whole life. I do. I think, all those things are fine. They all work, right? But here's some of the challenges, right? If you have if you're using a personal line of credit, they can always revoke that. Same thing with a home equity line of credit. So back in 2008, right, when the mortgage crisis happened, the banks were freezing people's lines of credit. Like you can't, I don't believe that happened to people's life insurance policies. I mean, I could ask Jonah to confirm this, but that actually belongs to you. If you have equity in your life insurance policy, you can borrow that money if it's available, use it, and then you can pay it off. So there's something to that. Also, what's nice is you will need with the income snowball for those people who are clients on the line, they know this, that you will need to increase the line of credit because you need to buy more, like greater amounts of investments later on. As your cash flow increases, as your income increases, the amount of investments you buy is going to also increase. And the calculator gives you a schedule of when that happens. So you can actually build your policy to such a way so that you increase the cash value later. You don't have to necessarily even buy more life insurance policies if you do this right up front. You can have part of your life insurance actually convert to more cash value life insurance later when you need it. So that, you don't, there's no credit checks, there's no worries about getting, it frozen. So there's a lot of advantages. To me, that is the best way. But if you haven't started with your policy and all that stuff and you're wondering how to do it, the income snowball can help you fund your policy as well. So if you haven't started that, I highly recommend talking to us so we can help you do that. But Jonah, can you answer that question? What happened in 2008? I mean, were the policy loans being frozen?
Yeah,
Do you
that's a
know?
great question. And the answer to that is absolutely not.
Right.
Policy loans were there. You could get access to them. Again, same rules apply. So it's not like you had to do a credit check or a loan process or anything. Actually, 2008 was an amazing time for people realizing that so much uncertainty was out there in the market. But if they had policy loans, they had certainty because it's guaranteed contracts that these insurance companies provide. So, yeah, I've seen people go get all the other bank products and then they go up and down and left and right and they go, "Oh no, what happened?" And I go, "Well, that's how it works. I thought you knew that when you signed up, right?"
Yeah. Yeah.
All right, Jonah, you have to be a US citizen to get life insurance.
That is a great question. You can be Canadian. You can have a green card. You can, um, oof, you put me on the spot with that one. Okay, the answer is you don't have to be a U.S. citizen. There are a few different ways to go about it and around it, but you do need to have a North American address. If you do not have one of those, the insurance company is going to give us a hard time.
Thanks. I've also got a couple questions about what companies you use. Mass Mutual, Guardian. Someone said, is New York Life considered a mutual company?
I love it. Those are great questions. So actually, you'll notice in my portion of today's presentation, I did not specify a company. The reason I didn't is because it's not actually about the company. It is about the product you buy from that company. So even in the chat right now, we had a couple people going back and forth talking about, well, should I get an indexed universal life insurance policy or a whole life? So I'll just repeat that again for those who are listening. It's not about what company, it's about what product you bought from that company. All companies are not created equal. All products are not created equal. You guys already know that if you think of your car insurance. Just because I have car insurance and Tanisha also has car insurance does not mean we have the same car insurance. I've got different options than she's got. Maybe there's different requirements where I live than where she lives. Maybe she opted in for the rental car coverage because she liked it from her company, but my company, it really didn't make sense for me to opt into it. So that's what's happening inside of Whole Life also. It's about the product you get from the company. However, we do use some of the majority and big companies that you've heard of. So absolutely Mass Mutual, Guardian, One America Financial, one of my favorite companies, Lafayette Life, Security Mutual Life. I can keep naming them. But again, it's not really the company. It's the product you get from that company. Good question.
Tanisha, I have like 6 questions about they want examples of fast burning fuel or what type of investments you use for those and if they have to find them on their own.
No, you don't have to. I mean, we can tell you what our clients use. I'll give you a couple of examples. So prosper.com, right? Those are, if you go to our website and you look at some of the testimonial videos. So Wayne Oshima, he's like old school. So he started with a platform that it doesn't exist anymore, but it's very similar. Prosper.com is peer-to-peer lending. So you're loaning money to people to do things like, start their business or consolidate debt or whatever, and it's diversified, and it's where instead of loaning $10,000 to one person, he loaned $25 to 400 different people, so his risk was spread out, and he was able to name his interest rate. He was able to figure out the term. His term was 3 years, and he was able to do all of those things. So Prosper's one, Ground Floor is another, and there are other ones out there, and then there's ones that companies have made specifically for our clients that you wouldn't be able to find out there in the marketplace. But those are two that are just out there that you can research for yourself. Yes, and we do help you do that due diligence as well.
Awesome. Jonah, I'm going to combine a few of these questions into one. People are asking about the length of time before they can access their cash value, how
Cool.
they build more cash value, and how long it takes. I think I covered it.
Okay, great. Okay, length of time before you can access cash value within 30 days of time, within 30 days from your policy start date. So again, within 30 days. Sometimes people go real fast, a week later or something. Sometimes because of banks or credit unions, maybe 14 days, 20 days, that sort of thing. Within 30 days of getting started, you can access cash value. Second question. I think I forgot, Lindsay. What was it? Second was
How do you get more cash value?
how do you get more cash value? I love it. Okay, so there's a couple different ways to get more cash value. Of course, contributing more will give you more cash value. It's the same with almost anything that you're going to do with income, right? The more you put in, the more you get out. Okay, so we got that established. However, the actual best way, my opinion, to get more cash value is actually to repay your loans with interest or with extra. Think about my bank example again, my little banking wheel I put on the screen. The bank does not make money when they loan you the money for the car. They make money when you pay it back with extra or with interest. If you do that same thing for your policy, you can grow your cash value. That's actually the biggest and most important step that we teach when we're walking people through how to use their policies and how to make them bigger and how to go faster. It's actually all about paying it back, which is another reason why I think it works so cool with the income snowball, because the income snowball teaches you to pay it back and pay it back quickly. 3 months, 4 months, 5 months. It's awesome. And then was there another one, Lindsay?
Minimum amount that you can
Oh,
get.
I love it. Okay. So when you're actually starting an infinite banking policy, you actually get to choose the dollar amount that you put into the policy to get started. Very, very similar to the income snowball. I do have a recommendation, but the real answer is you get to pick. My recommendation for you on a minimum level, you do not have to do the minimum level. You can put in as much as you want to put in, as you have, especially if you understand how it works. You'll understand you probably want to do more rather than less. But if you're worried about minimums, take however old you are, add a zero, and that's how much you should put into your policy each month. Okay, take however old you are, add a zero. You should at least do that amount each month into your policy at a minimum level to get started.
But then you can pay it annually with your income snowball for income snowball people.
You sure can.
Yeah.
Um, um, we'll take they keep coming in. So we'll take 2 more and then we'll be done because we're going way over here. So people are asking, what's the difference between Money Multiplier and some of the other life insurance vendors out there and the different kind of terminology, that people use?
Yeah, I can totally be helpful with that. So there's a few things that you want to pay attention to. So all those who are trying to gonna go do their research after this call, let me give you what to type in. Okay. First and foremost, the book that I recommended earlier is called Becoming Your Own Banker. It was written by a gentleman by the name of R. Nelson Nash. He is the one who discovered that you could be a bank through life insurance. Infinite banking is his term, and there is an institute where you should go through if you want to help people with infinite banking, where you can be certified. So actually, infinitebanking.org is where you want to go, and you want to search for someone who is certified. If you go there, what you'll notice is I'll be on that site, and my friends over at the Money Multiplier, Hannah and Brent and Chris and whoever else you're looking for will be on the site. That's first. So if you're seeing somebody on the internet or you're searching somebody and you're like, well, what's the difference between them? Search that site. Are they there? Okay. Secondly, if they are not there and they are promoting some other type of insurance, you can do infinite banking using indexed insurance, universal insurance, index universe, and they are not saying the words whole life, WHOLE. Run away. Don't do it. I'm not saying those insurances are bad. I'm saying you cannot use those insurances for what we taught you today on this phone call, on this video call. You cannot use them. So you want whole life. Okay. So really, other than that, as long as they're certified to be able to teach and talk about what we're talking about today, and they are saying whole life, then generally speaking, you might be okay. What makes the Money Multiplier different actually is the same thing that makes Tardus different, our coaching. We are going to help you. We're going to walk you through it every step of the way. We're going to make sure you know what you're doing, what to do next. We're going to set calls with you. Like we're actually, not only do we use it ourselves, but we'll help you use it and walk you through it. So I think that makes us different. Tanisha said, was it 0.3, Tanisha? Or was it 0.4? Am I messing it up? Which one was the teamwork and having a coach? Which one was that?
3.3.
3. There it is.
Yeah.
Okay, I think that's all the questions we're going to take for now. There was some specific ones that are like person specific, situation specific. You want to reach out to Jonah or reach out to one of the wealth coaches at Tardus to get questions like that answered. And so I think that's it. Anything else, guys?
No. Awesome. Thank you so much. This was great fun.
Yeah, thanks for having me. I look forward to chatting with you guys. So if you haven't booked a call yet, please do. I'd be more than happy to talk and walk you through your situation. That'd be fun.
Awesome.
Thank you guys so much. Talk to you later.
Bye.